Welcome to NeoRiseWay, where financial topics are explained in a simple and beginner-friendly way. Today, we are talking about market cycles. Financial markets do not usually move in a straight line. Prices can rise, slow down, fall, recover, and then repeat similar patterns over time. This movement is often called a market cycle. A market cycle usually has different stages. The first stage is often growth. This is when confidence improves, activity increases, and prices may begin moving higher. The next stage can be a peak. This is when prices have already moved up strongly, and the market may start to slow down. After that, a decline can happen. During this stage, prices may move lower, confidence may weaken, and people may become more cautious. Then comes the recovery stage. This is when the market begins to stabilize, confidence slowly returns, and prices may start improving again. These stages are not always easy to see while they are happening. Market cycles can be short, long, smooth, or uneven. Different markets can also move through cycles at different speeds. For beginners, the main idea is simple. Market cycles describe the natural rise, slowdown, decline, and recovery that can happen in financial markets. Understanding cycles can help make market news easier to follow. It also helps explain why markets can feel positive at one time and cautious at another. At NeoRiseWay, our goal is to make financial education clear, calm, and easy to understand. Thanks for watching, and keep learning one step at a time.